It's a Friday morning. Here's the kind of lead you're dealing with trading in markets as we head into the weekend. From the U.S., we have the Dow, the S&P, and the NASDAQ all moving to the downside. Combination of Cyprus and some disappointing economic data from the Eurozone. Peter Bain is president and CEO of Old Mutual Asset Management, which has assets under management of just over $200 billion. He knows what he's doing out there in the markets, and he's joining us now from New York. What do you think? You've got $200 billion on the line. Peter, is this the beginning of a correction?
From my perspective, not a correction. I don't think there's enough genuine underlying economic data that's truly negative and a genuine sustained trend to be a correction. I think probably it's a pause. I think we all know markets are psychological animals, and I think that you look at what the market is focusing on. Because interestingly, you actually had some very good economic news here in the United States today in terms of housing, in terms of the jobs report. But the market elected to focus on Cyprus and some disappointing news out of Germany in particular, and that took the market down. I think that the underlying global macroeconomic environment, the actual economic conditions, are remaining fairly strong. To the extent the market elects to take a breather, it can focus on the challenges that lie ahead in the Eurozone. Those challenges aren't new. They've just shifted to Cyprus. And the challenges that remain for the policymakers and politicians to get their arms around, both in Eurozone and in the States, debt, deficit, and entitlements.
Okay, for the first time, yesterday we had the BOJ Governor Kuroda making some comments about how determined he is to hit 2%. And for the first time, we're starting to see commentary and opinions that, you know what, this stimulus is going to come over and affect you guys in the United States, more particularly if they're buying longer dated assets in Japan and the yields go down. The Japanese holders are going to go looking for yield elsewhere, probably in your 30-year treasuries. How would that sort of play out in the markets? Well,
hey, you're right that I think the markets, at least look, from my perspective, I was impressed that Kuroda-san was as strong in his statements. We'll see if it works, but it certainly is a bold step. The issue to me is when you start reallocating assets away from the fixed income instruments that will have yields go to zero, it may or may not go to other fixed income instruments. The interesting question to me is, if in fact underlying economic environment is strong, you may see assets seek equity returns with a belief that that growth can be forthcoming. It may not go to other just fixed income. It may move into other asset classes. It may move into real return classes, real estate and timber. So I think it's not just a question of do assets move into U.S. Treasuries, it's where do they go once they leave Japanese bonds.
Okay, yeah, good question. Listen, Peter, we got to go. Do it again soon. Have a great weekend. Peter Bain, Old Mutual Asset Management there.